Hi, this is Jonathan Lopez with Platinum Wealth Management. We put this video together to help explain the monthly asset allocation update. In general, the standard guideline for the core portfolio is 50% stocks, 50% bonds. This may be adjusted based on an individual's particular investment objective, risk tolerance, and time horizon. There are times, however, when the market can become significantly overvalued and represent a high risk for a correction or downturn. Examples of this were the real estate markets in 2005 and 6 and the stock markets in 1999 and 2000. These are often times of excessive greed and euphoria in the marketplace, followed by severe and punishing correction. In such instances, we would want to minimize our risk by dropping our allocation down to 25% stocks and 75% bonds. At other times, the market can become significantly undervalued and represent a unique buying opportunity. These are often times of excessive fear and pessimism, followed by a strong and prolonged upward cycle. Under those circumstances, we would want to increase stock exposure to 75% to capitalize on the unique buying opportunity. Do we mean to say that when things look wonderful and everybody is buying, we should sell? And when things look terrible and everybody is selling, we should buy? Yes, that is exactly what we mean. As Warren Buffett likes to say, be fearful when others are greedy, and be greedy when others are fearful. Does the market give clues when it may be sufficiently overvalued or undervalued to warrant a change in asset allocation? Benjamin Graham gives 3 guidelines to help gauge market valuations. The first guideline is based on the ratio of prices to earnings, commonly known as the PE ratio. Historically, the stock market has traded around 15 times earnings. A PE ratio above 20 to 22 would indicate the market has become overvalued and may be due for a correction. Conversely, a low PE around 10 to 12 would imply that the market is trading very cheap and may be a good time to buy. Graham's second guideline is based on the relationship between the dividend yield on stocks and the dividend yield on bonds. Generally, stock dividends are lower than bond dividends because investors are willing to take a lower yield in exchange for the stock's appreciation potential. The difference in yields represents the cost of the appreciation potential. When the difference is high, it represents a high cost and may be a time to favor bonds. When the difference is low, stocks appear more attractive. When the investor could capture at least 70% of the bond yield by owning stocks, it could indicate a good time to buy more stocks. The third guideline for valuing the stock market is found by comparing the earnings yield on stocks with the dividend yield on bonds. A yield spread of at least 4% would indicate that companies have sufficient earnings to not only pay their dividend, but also to reinvest toward the future long-term growth of the company. A negative yield spread would be an indicator of risk in the long-term outlook for stocks and bonds, thus a time to decrease in exposure. When all 3 indicators are signaling either an overvalued or undervalued market, we change the recommended allocation. At all other times, we advise maintaining close to a 50-50 stock bond mix. To give you a sense of the frequency of adjustments, the last time an increase to 75% stocks was triggered was December 2008. And the last time the indicators signaled a move to 25% stocks was in 1999. We don't expect frequent changes in allocation, but we look at the 3 indicators every month to stay current. We hope this brief video helps explain the monthly update.